we start working our way down to a point where we never lose. What is the maximum stop before certain targets are reached? And we got to a 50-50 chance using a 35 tick stop where we could make 30 ticks profit, and we never ever lost on any max trade ever using a 35 tick stop and a 30 tick target. Now, when I say ever, I'm not going back to 1926. I'm going back over the last few days, right? I'm going back over the last 20 trades. So, obviously the challenge with that is that there's not many retail traders are going to say, yeah, let's do it. I'm going to put a 5 lot on with a 35 tick stop. I'm going to take a 1500 tick stop on that trade, which is 1% of my account because my account size is 150 grand. There's not that many retail traders in that position to say, yeah, I've got 150 grand to put into that trade. But obviously, on the basis that you just did 20 winners out of that process at 1%, that's a 20% return eventually. A 20% return without a single percent drawdown, without 1% drawdown, guys. And that's based on this trigger here. It's based on this actual trigger here. And you can see that that's that sell that's just came in just there. Now, 35 ticks, it's gone from 88s down to 84s. So that's 30 ticks has been achieved, hasn't it? It's already done 30 tick profit on that. But where was the stop on that trade? Where would the stop have been on that at 88s? Well, of course, it would be at 91.5, wouldn't it? The hard stop would have been up here. So there's your hard stop up there. And you can see, obviously, inside of a max, that stop has never been taken based on that parameter. Every time you do a trade idea, every time you develop out a trade idea, there's always that different way of approaching the question. A lot of people think that there's only one question when you come up with a trade, is it successful or not? But that's not success. That's not good enough. You've got to define in your mind and in an algorithm's mind what success is and how much risk it takes to get that success. So if I say to the algorithm, I want 100% success rate and I want 35 tick profit, the algorithm goes into the triggers and it calculates how much risk I have to accept, correct? Does everybody understand that logic? I'm sure the system programmer guys will, but does everybody else? It's just a different way of approaching. It's just a different way of approaching the process. So if I have a trigger, let's assume that I always get a trigger here, a sell trigger here. That's a sell trigger level. Sometimes this will happen. Sometimes this will happen and then this will happen. Sometimes this will happen and this will happen. Sometimes this will happen and then this will happen. Sometimes that will happen and then this will happen. You know, if we're looking at this idea here, my question is, if I get a trigger, I want to win 100% of the time. And the algorithm will say, okay, well, 100% of the time is here. The algorithm will say 100% winners is here. And I'll say, well, that's too small. And then it'll say here, still too small. So 100% winners stops at that price, doesn't it? Because that one doesn't go any further. So that's where we reach 100% winners at that stage. Okay, so that's us achieved that first element, 100% winners. Now 100% winners, but how much risk has had to be taken to achieve those 100% winners? So obviously the algorithm then has a very simple job of just looking in the background and saying, right, that's the maximum risk you had to take to achieve those 100% winners, right? So that has a calculation. So we can start with that calculation, and number one, we can try and say, well, is that a maximum risk acceptable for everybody? Is that maximum risk workable to win 100% of the time? Because you guys, I mean, a lot of people say 100% winners. Everybody could have a 100% winner algorithm, guys. If I told you to buy oil on every single downtick today and take a one tick profit, you'd have 100% winners. What do you mean? Because I'd just tell you to take a 6,000 tick stop, which means you're going to have an awful lot of open trades that simply haven't ever been stopped out, right? So in light of that, in light of that process, well, Jack, you might laugh at it, and it is absolutely laughable. But there's an awful lot of algorithms. When I was coming into the retail space and looking at MT4, for example, there was a lot of algorithms that did that. They had these profit and loss profiles that were straight lines up, and people were buying. They were paying $1,000. Kim will know this. People were paying thousands of dollars to buy these stupid dumbass algorithms that had a profit and loss profile of 1,000 straight line up, straight line up. But the only reason that they were straight line up and they were winning 99.999% of their trades was because one single losing trade with a massive stop wipes out your account, doesn't it? One single trade with a massive stop wipes out your account. There's no point to it. It's rubbish. It's absolute rubbish. Classic. And yet people bought it because they weren't sufficiently educated to understand risk and reward, were they? And that's the point. They weren't sufficiently educated. And the snake oil people lent on that process. They lent on people not being educated to ask the right questions. Look at this profile, guys. We win 100% of our trades. Wow, where do I sign? $999.99, guys. Guaranteed, you'll never lose. People bought it. Lots of people bought it. But this is how we approach the markets. We look at the maximum risk. Well, it is. That's why, Jack. That's why casinos do table limits, because they know that eventually there will be a black following a sequence of reds. So if you had enough money on the planet, if you had all the money on the planet, you would never lose playing roulette, would you? You'd always make money. You'd always win $1 because you just double down on every single round, wouldn't you? You would never lose because the table would have to be completely wonky for it to throw up, 70 blacks in a row, there are 70 reds in a row. Do you know what I mean? Could it happen? Of course it could happen, but it's trillions to one. Trillions to one. But anyway, what we do is we work out where 100% winners are, and we look at the maximum risk. Now, what we then do is we say, what about 90% winners? And let's assume we had nine of these things, and we said 90% winners. Well, the 90% winner threshold would allow us to move the profit target to this level, wouldn't it? So our profit target would move to that level if we were trying to achieve, for argument's sake, 90% winners. And then we would ask the question, 90% winners, okay, so what would be our maximum risk? Well, obviously it depends what this bad boy does here. Because what we'd have, if we stop at 90% winners, this one that didn't win, what ultimately happened to that trade? If it didn't win, it must have lost, right? So if that trade must have lost, we can obviously start looking at that one trade that didn't win here, and we can analyze how much it lost, and we can go back to this idea of the fact that it maybe reaches a point where it's higher than every other takeout, and that's the maximum risk. So we know that 90% winners, one loser gives us a certain profit and loss. And we can start calculating that out, can't we? Because even just eyeballing this exercise here, we can start doing some sums. The win-loss ratio of this, of course, if we look at the original win there, and you can see that that's 1 to approximately 3 times. Approximately 3 times the risk. So we're assuming we've done 10 lines here, guys. We're just assuming 10 lines, right? So if we're doing 10 lines, I'm taking a 3 to 1 risk reward, 3 risk, 1 reward. So on 10 trades, I would make, say, $100. So let's assume this is a $100 target price here, and this is a $200 target. Of course, that looks reasonable. So that would be a $200 target. This would obviously be a $300 risk at this stage. We can do the sums, can't we? We can do the sums. So I could do 10 winners out of 10 during this phase. I could do 10 out of 10, and obviously I know I'm going to make $1,000. and I'm taking a $300 risk. So I'm trading about 3 times my money, right? Approximately 3 times my money at that stage. 3 times my risk for that process. 3 times my risk to make the money. So that's good. What about this one? Well, obviously, if I've got 9 winners and I'm making $200, I'm making 9 out of 10, and I'm making $1,800. But obviously, I've got a loss of 300. So obviously, now I'm making a $1,500 profit. Now, which one's right and which one's wrong? What's the best one to use? What's the best one to use? I'm making $1,500 profit now against $300 risk. I'm actually getting 5 times my money. 5 times my money. But which one's the best one to use now? Well, there isn't actually technically a right answer to that. There's always a best strategy in every game, isn't there? There's always a best strategy in every game you play. The bigger the value, the bigger the trade, right? The bigger the opportunity. But that still doesn't answer the question. I've said this before about horse racing. You may recall a conversation about the best value you can ever get is usually on some of the big outsider horses. It's running at 500 to 1, but it's actually should be a 50 to 1 chance. Well, it's still only got a 1 in 50 chance. Even with your rating, it's got a 1 in 50 chance of making to winning that race, right? But you're getting 500 to 1 odds. So you should really back that horse at the 500 to 1 odds, shouldn't you? Now, what that means is that you're probably going to lose as much as 50 races in a row. So that might mean that you're busted. It might mean that you don't have any money left in your account. But if you get a 501 in, then you're in great shape, right? That's the problem, because getting that 500 into your bank requires that you sit on your backside and do nothing for ages. You sit on your backside and do nothing. You take the losses, you're happy with the losses. There's very few people that will run 50 losses in a row and still be happy to do it. So you've got to have that idea that whilst that might be the best, most productive strategy, it's still not a strategy that you can use. And this comes back full circle to the conversation I was talking about diets and exercise and all those other things. Doing an exercise, doing a diet that you don't enjoy or you don't like, or it doesn't fit in with your time set, the times that you've got available, and it doesn't fit in with your enjoyment or anything like that, you're not going to stick it. Don't do it. It's pointless. You've got to always find something that actually works for you according to what you're trying to achieve, according to what you're trying to make money based around. And that's what we're trying to do when we're trading, guys. We're trying to do that process, aren't we? So I thought it would just give you a bit of insight into the process behind optimizing these ideas. Anyway, how did everybody get on with their long oil trade, guys? Come on, seriously. Come on, seriously. We've been shouting for this long oil trade. We gave you a couple of heads up against that 62.10 stop level. I said that we would expect to see perhaps a buy-side surge at the NYMEX Open. What do you think, guys? Anybody? Nobody? Everybody? We thought we would get the buy-side surge at the NYMEX. We got the buy-side surge at the NYMEX, and that's what we were working towards, was to stay in the game long enough to get the NYMEX Open, and we got a very, very nice surge, guys. That's nearly $1,000. That was nearly $1,000 live call from the bottom edge oil, guys. You can't make it up. You'll see that an hour ago we started this whole process, but we gave up on the process and flipped into a sell trade here. I was buying this phase, I was selling this phase, and I started to buy this phase. Buys, I was selling this phase, buying this phase, selling that phase, and buying this phase. Just adding a bit of value, guys, adding a little bit of value. You gotta love it.